Welcome to The Explainer. All right, today we're going to tackle a huge contradiction that's playing out in the Bitcoin market. We've been talking about how global sanctions are creating this deep structural demand for Bitcoin, right? But then just the other day, the price fell, and it fell hard. So what's the deal?
Right. Let's get straight into it because this is the central question we're going to figure out together. Now, on the surface, it seems like a total contradiction. But as you're about to see, the market has different layers, and they all operate on completely different timelines. So on one hand, you have this really powerful long-term idea, the thesis that geopolitical problems are actually a fundamental driver for Bitcoin. But then, on the other hand, you've got the cold, hard reality of a big red candle staring you in the face. So let's unpack this.
To really get to the bottom of this, we have to understand something crucial. Not all demand is the same. There is a world of difference between the kind of buying that moves the price day to day and the kind of demand that builds a long-term foundation for an asset.
You see, sanctions don't create that flashy, headline-grabbing buying you see on the news. No, they create something we call strategic demand. This is, well, it's long-term, it's quiet, and it's done by players who have a fundamental need for a neutral financial system. They really couldn't care less about the daily market hype. So how exactly does this work? Well, imagine you're a country or a major corporation, and suddenly you're cut off from the SWIFT system, or you're blocked from settling trades in US dollars, or your bank access is just frozen. You're basically cut off from the global economy. In a situation like that, Bitcoin stops being a speculative asset and becomes a critical tool, a bridge for settlements, a rail for transferring value, and a hedge for your reserves. And here's the most important part. This strategic demand, it all happens in the background. It's done on over-the-counter desks. Think of them as private markets, far away from the public exchanges. You see, these buyers, they're not staring at charts chasing green candles. They are methodically accumulating for a very specific strategic reason, and that's exactly why you don't see it reflected in the price every single day.
Okay, so if that quiet strategic demand is still happening in the background, then what actually caused that price drop? If the sanctions thesis didn't fail, where did all that selling come from?
Well, what happened was a classic risk-off event. That's just market speak for when big-picture uncertainty makes investors dump risky assets. That's what started the slide. Then it got way worse because a bunch of leveraged traders got liquidated. But here's what's crucial to understand. This was not countries selling their Bitcoin reserves. It was not those sanction-driven buyers changing their minds. This was a market structure event, not a fundamental one.
The real culprit behind the drop was just a temporary market-wide freak-out over geopolitical stress. And this is where we run into a fascinating irony, a real paradox at the heart of the Bitcoin market.
And here it is. This is the central paradox you have to grasp. The very same geopolitical tensions that are creating this incredible long-term structural need for an asset like Bitcoin are also the exact things that cause traders to panic and create all this volatility in the short term.
So, what was in today's macro cocktail of fear? Well, you had rising trade tensions between the US and Europe, new threats of tariffs flying around, and just this general feeling of uncertainty rippling through all capital markets. This created that classic risk-off environment where traders get nervous and just start looking for the exits.
And here's how that chain reaction plays out. First, that macro uncertainty ticks up. Then, hedge funds and their trading algorithms are programmed to immediately cut risk. So they just start selling everything. And in those brief, chaotic moments, an asset like Bitcoin can suddenly start trading just like a tech stock, moving in lockstep with the rest of the market.
What we saw was a classic liquidity event. This has nothing to do with the long-term value of Bitcoin. It's about a short-term, urgent need for cash, forcing sales across the board. Think of it as a market-wide hiccup, not a failure of the entire thesis. So while all this chaos was happening, with leveraged traders selling and algorithms de-risking, there was another group, a group that was completely calm, quietly taking the other side of that trade. And yep, these are the strategic players we were just talking about.
And their playbook, well, it is the total opposite of a typical trader glued to the news. They actually want the price to be weak because it lets them buy more for less. They build their positions slowly, in stages, so they don't move the price, and they do it all behind the scenes, away from the public eye.
For these quiet accumulators, volatility isn't a problem to be feared, it's an opportunity to be seized. It's why you hear people in the know say that sharp drops like the one we just saw are not a bug, They are a feature of the market that gives them the perfect cover and the perfect price to build out their long-term position. All right, let's put it all together now. It's time to separate the temporary, distracting market noise from the real, underlying long-term signal. And this lays it out perfectly. On one side, you've got all the noise. We can call it the FOMO layer. It's made up of leveraged traders, momentum chasers, and pure emotional reaction. And on the other side, that's the signal, the structural layer. That's the long-term holders and those quiet, strategic, over-the-counter flows. The price drop was a crack in the noise layer, not the signal layer.
So if we just tune out all that daily chatter for a second, what's left? What are the fundamental forces that haven't changed one bit? Well, that structural demand is still there. Bitcoin's supply is still mathematically limited, and the global trend of sanctions is only expanding. It's definitely not reversing.
And this is such a powerful point. When you really think about it, Bitcoin's long-term value proposition isn't tied to hype or short-term sentiment. It's tied to these huge, slow-moving shifts happening on the global stage. It just needs the world to keep doing what it's doing. This really is the key takeaway for understanding the bigger picture. If you look at sanctions as a catalyst for a quick trade, you're missing the point completely. They're a deep, structural force that is slowly but surely reshaping the entire global financial system. And this brings us to a fundamental truth of pretty much any market out there. You have smart, strategic capital that uses volatility to its advantage, accumulating quietly. And then you have retail capital that more often than not reacts emotionally to the price swings. That difference in behavior is what defines every single market cycle. So we'll leave you with this to think about. In a world that continues to fracture financially, is all this loud, daily price action just a distraction? And is that silent, steady, strategic demand the only force that's really going to matter in the long run? Thanks for joining us on The Explainer.